Welcome back to this explainer. Okay, so if you've ever just sat there staring at a price chart and felt, completely overwhelmed by the sheer chaos of it all, you are absolutely in the right place. Today, we're doing a deep dive into the insights of veteran trader Steve Miller, and we're specifically looking at his recent breakdown of the Euro USD. We're going to see if we can take what looks like totally random, chaotic market movements and actually transform them into a highly structured strategy. It's all about separating those golden signals from all that absolute noise.
Because, man, it's an incredibly relatable problem, isn't it? You sit down at your desk, you pull up your charts, and the price action just looks like it's vibrating. It's bouncing up and down without any rhyme or reason. And honestly, it is so frustrating when the market is just doing whatever it wants. Trying to force a trade in those exact conditions? Yeah, that's basically a one-way ticket to draining your account. But what if you had an exact methodology to navigate this? What if you knew exactly when you should sit on your hands and exactly when to strike? Well, that is literally what Steve Miller's framework is all about.
Okay, let's dive into this. Here is our survival blueprint for today. 1. Range versus trend. 2. Spotting high probability setups. 3. Surviving market randomness. And 4. The independent trader mindset.
Starting right off with Section 1, Range versus Trend, establishing the market environment. To understand this first crucial step, we really need to look directly at the price structure itself. Miller makes a huge point of this. As early as possible, you have got to identify whether you are in a trading range or a directional trend, and you need to do this on each and every time frame you look at. This right here is the ultimate foundation, guys. It completely dictates how you're going to trade. If you have a clear trend, right, you trade momentum. But as we can clearly see right now with the Euro USD, we are bracketed by very defined highs and lows. We're stuck in a trading range. And when you are in a range, your whole playbook has to shift. Those high probability opportunities, they do not happen in the messy middle. They form right at the absolute edges of that range.
Now, what's really interesting about this next part is how we actually find the entry. Section 2, Spotting high probability setups, waiting for the trigger.
So now that we understand our environment is a range, we need to know exactly what to look for at those edges. We need to define the exact trigger we're hunting for. To really grasp Miller's setup here, let's look at the recent history of the Euro USD. The price moved all the way down to the bottom edge of our range, right? But it had zero follow-through. Even though it closed near the lows, it just completely stalled out. And what happened next was super fascinating. We got a series of consecutive inside bars. Basically, an inside bar is a price bar that is entirely contained within the high and the low of the previous bar. Miller points out that we saw one inside bar and then another one, which basically created this incredibly tight 4-week trading range. This is literally the market hitting the pause button. It's like the chart is pausing and asking, okay, wait, are we actually forming a low here?
And this pause, it is absolutely vital because it introduces this concept called base consolidation. See, before this tight little range formed, the EUR USD had been stuck in a really prolonged bearish trend. And the thing is, markets rarely just snap back in a perfect clean V shape after a long downtrend. They need some time to kind of work off that heavy downward pressure. And that is exactly what this sideways base consolidation is doing. It's building a firm foundation. That way, a new move can actually be sustained over time, rather than just delivering a sharp, totally untrustable whipsaw up or down.
So when you combine all these elements, it gives us this highly specific, super high probability swing trade setup. Let's break it down. Step 1, you just wait for the price to reach the very edge of the trading range. Step 2, you identify your trigger pattern. In Miller's recent analysis of this pair, the trigger was a down base consolidation long, meaning the price moved down, it formed that solid base with those inside bars we talked about, and then it triggered a long entry the moment it traded up and broke out through that tight 4-week range. Finally, step 3, risk management. Miller likes to use a higher daily low as his firm stop loss. It's just such a beautiful illustration of how cycle analysis informs your timing, but the actual price structure, the pattern itself, dictates the move and draws a very clear line in the sand for when to get active.
Which brings us to Section 3, Surviving Market Randomness, the discipline to do nothing.
Okay, so we just walked through a beautifully clean setup, right? But what on earth happens after that trade finishes playing out? Well, we shift straight from clear signal right back into absolute noise. Just listen to this quote from Miller regarding the Euro USD ever since that last clean setup triggered. He describes it as moving up and down doing random stuff. And he's right. Since that swing trade hit, there haven't been any obvious screaming setups. The market is just back to vibrating.
And listen, when there is no clear reason for why the price is moving and absolutely no identifiable pattern, you literally just have to let it be. Markets go through these frustrating phases of pure randomness all the time, and trying to force a trade during these phases, that is exactly how independent traders end up bleeding out their capital.
So how do you actually survive this? Well, first, you stay far, far away from those random phases. Just don't touch them. Second, you patiently wait for clear reasons and signals, like that base consolidation we just unpacked. But the third bullet point here, this is the real secret weapon. Maintain a large universe of symbols. Think about it, if you only trade the EUR USD and it's doing random stuff for an entire month, you're going to get incredibly bored. And when you get bored, you're going to force a bad trade. But if you track a big, diverse universe of symbols, you aren't just sitting around twiddling your thumbs waiting for one specific asset to trigger. You can optimize your position sizing and focus your capital only on the absolute highest odds plays across the entire market, all while happily ignoring the random low odds charts.
Now, of course, just because we are waiting on the euro US dollar doesn't mean we aren't actively watching it. Miller is tracking a very specific technical zone for his next potential signal on this pair. He's looking right at the 116.29 to 115.77 area. And specifically, he's keeping a really close eye on the 0.786 retracement, which is a key mathematical pullback level right around that 115 mark. Having these specific zones completely mapped out in advance is a massive game changer. It means that when the market finally stops doing random stuff and actually reaches your area of interest, you're already there, calmly prepared to see if a brand new trigger forms.
Moving on to our final section. Section 4, the independent trader mindset, shutting out the crowd.
So the crucial point here is that we need to zoom out from the charts for a second. Because honestly, you can have the absolute best technical analysis in the world, but if your psychology is broken, the strategy will fail every single time. So how do you actually learn this level of discipline? Well, Miller is super transparent about this. Nobody just handed him a magic formula. He learned how to identify high odds versus low odds plays through relentless, grueling trial and error. He built his own workflows from the ground up. And in an industry that is just totally full of gurus trying to sell you shortcuts, fully accepting that true mastery only comes from your own trial and error, that is incredibly liberating.
And doing all that trial and error, that's what builds your armor against the noisy crowd. I really want you to absorb this exact quote from Miller. It doesn't matter what anyone says, I don't really care. I don't care if anyone thinks it is going higher. Completely irrelevant. Now that is some intense, empowering energy right there. Once you have actually put in the hard work, when you've mapped out your trading ranges, identified your own base consolidations, and set your own lines in the sand, the opinions of everyone else out there, whether they're yelling on Twitter, talking on TV, or posting in a forum, become completely 100% irrelevant.
And this brilliantly illustrates the ultimate goal of trading, which is 100% ownership. When you build your own specific workflows based entirely on your own trial and error, that strategy belongs to you. You aren't just borrowing someone else's conviction, you are entirely focused on what you are doing, independently analyzing the cycle timing and the price structure. And the beauty of that is, if a trade wins, you totally own that success. And hey, if it loses, you own the lesson. No pointing fingers. Which leaves us with this final, really powerful question to reflect on. Are you trading the market, or are you letting the crowd trade you? The next time you look at a choppy chart like the Euro USD, I really challenge you to shut out the noise, find the range, wait for the base, ignore all those random movements in between, and rely entirely on your own independent analysis. Thank you so much for joining me in this explainer today. Keep focusing on those high probability setups, and I will see you guys next time.